Hello guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe this channel. Stocks tumble, dollar soars, and bonds plunge as recession fears grow. New York or London Reuters. US and European stocks tumbled on Friday. The dollar held a 22-year high and bonds sold off gains against as fears grew that a central bank prescription of rising interest rates to tame inflation will drag major economies into recession. The Dow narrowly missed, confirming a bear market as a deepening downturn in business activity across the Eurozone and US business activity contracting for a third straight month in September, left Wall Street wallowing in sea of red. The British currency and debt prices weakened further after the UK government's announced huge debt finance tax cuts that will boost borrowing, sending UK bond yields vaulting higher in their biggest daily increases in decades. The euro plumped to 20-year low and sterling to a 37-year low, while the dollar soared after the Federal Reserve this week signaled rates would be higher for longer. George Gonsalves, head of U.S. macro strategy at MUFG, said the Fed wants financial conditions to tighten and high interest rates were the mechanism to deliver a market investors had not seen for a long time. It's something we're not used to. That's why it's more surprising for most. He said it's going to be a long, stirring contest between the Fed and the markets, and in the middle is the economy which is not responding yet to this tightening. MSCI's World Stocks Index shed 2.7% to almost two-year lows. The Pan-European Stock 600 Index closed down 2.34%, its biggest weekly loss in 3 months. On Wall Street, the Dow Jones Industrial Average fell 1.62%, the first major U.S. stock index to fall below its June trough on an intraday basis, but the blue chip index averted, confirming a bear market, as it missed closing 20% or more lower than its record high, according to widely used definition. The S&P 500 and the Nasdaq Composite, already in bear market territory, fell 1.72% and 1.85% respectively. Britain, Sweden, Switzerland, Norway, and other countries also hike rates this week, but the Fed signaled it expects hike U.S. rates to persist through 2023, spark the rout in equity and bond markets. Investors are trying to get a handle on inflation and how high rates will go, said Andres Skiba, head of the Blue Bay U.S. fixed income team at RBC Global Asset Management. There's unease in the market about having confidence that we know how inflation will develop and that yields will indeed peak in the mid-high forex, he said, referring to a Fed projection of the Fed funds rate at 4.6% in late 2023. People have been reflecting on that uncertainty, and it may mean more tightening ahead. It might mean even more tightening of financial conditions that the markets have to go through. The euro fell for a fourth straight day, sliding 1.49% to 0.9689 dollar after data showed the downturn in the German economy worsened in September. The dollar index rose 1.6%. The Japanese yen weakened 0.68% to 143.34 per dollar, but fell to notch its first weekly gain in more than a month. On Thursday, Japanese authorities intervened to support the currency for the first time since 1998. UK bond prices went into a tailspin with yields on the 5-year gilt leaping 51.4 basis points to 4,000.52%, the largest one-day rise since at least late 1991. According to repetitive data of the government unveiled tax cuts, a bond surprise moves counter to its yield. Okay, that's all from me. Thank you for watching. Don't forget to like, share, comment, and subscribe. Thank you.